In these two videos, we're going to take you through the understanding of financial statements. In the first video, I'm going to go through the major financial statements, the income statement, the balance sheet, the statement of cash flows, and the statement of retained earnings. And in the second video, we'll go over financial statement analysis. The purpose of this is to help you understand what we use financial statements for. They're used in accounting and they're used in finance, and basically financial statements are used as a way of communicating in a company. And so it's important that everyone understands what the financial statements are telling them. So one of the four main financial statements is the income statement. The income statement tells us the results of operations, and here's a sample income statement so that you can see the 2 years for this company. So the income statement covers a period of time. Typically that's 1 year. So this would be the results of operations for 2006 and 2007. And so the income statement always starts with sales and then has cost of goods sold. So these would be the direct costs of bringing to market whatever it is that the company sells. Then these would be other expenses like administrative expenses, rent, other kinds of operating expenses. Depreciation is the cost of writing off an asset. So when we buy big assets like a building, we do not expense it in the income statement. We write it off over its life. So this depreciation would represent a portion of the cost of the assets that the company has purchased over time. Depreciation is not a cash flow, it's an accounting entry that tries to match the benefits from the asset with the revenues that it's generating. So when fixed assets are purchased, they show up on the balance sheet, which we will look at next, but their cost does not show up on the income statement. Only the writing off over time shows up as depreciation. So all of these together are the operating costs, the cost of the goods that were sold, any other expenses in the routine operation of the business, and depreciation equal total operating costs. So we sum these three and get 3.22 million. So sales minus total operating costs gives us earnings before interest and taxes, EBIT. This is sometimes also called operating income. From that, we subtract any interest expense on debt, and then that leads to earnings before taxes. We subtract taxes and we get net income. So net income is the results of operations. So this company in 2006 had 3.4 million in sales and only 87,960 left in net income after all the expenses were taken out. So if we look at what happened in 2007, sales went up a lot. Sales went up by 2.4 million. So that's like a 67% increase in sales. Cost of goods sold went up a lot. It looks like proportionally more. Other expenses just about doubled. Depreciation went up a lot. And so in the final analysis, even though sales went up by 2.4 million, they ended up losing money. So this is a net loss, it's negative. Okay, and why is it negative? Because probably mainly this one right here, the cost of goods sold is so high. Now, notice something here. This is a negative. When a company has paid taxes and they suffer a loss, they get a refund of past taxes paid. So this tax number here is simply 40% of earnings before taxes. Same thing over here. This is 40% of the loss before taxes. And so they actually get to recoup back taxes paid. And so that has the effect of lowering the loss. So they lost 158,560. They got a tax refund of 63,000. So their net loss was only 95,136. Okay? So sales increased by over 2.4 million, but the costs increased by more than sales, and that caused the net income to be negative. Okay, so let's look at that again for a second. So this is the results of operations for 2 years. Okay, it covers the whole period 2006 and 2007, and basically tells you how much money that the company made, how much they sold, and how much they had left at the end of the year. The balance sheet, on the other hand, tells us the firm's position at a point in time. So the balance sheet is a list of the assets and the liabilities that the company has at a point in time. So this would be December 31st, probably 2006 and 2007. So they had cash, and you can see that their cash balance decreased from 2006 to 2007. Short-term investments are places to put excess cash, and we sometimes call that marketable securities. So the sum of these two together is really the cash that the company has on hand. Their short-term investments also decreased by quite a bit, so they were using cash, is what we can see from looking at this. Accounts receivable arise when the company sells something on credit. So the firm makes a sale, but they don't make a sale for cash. They sell it on credit. And so the people that bought the product owe the company money, and that's called an accounts receivable. So you can see that their accounts receivable increased by a lot. And that's consistent with the increase in sales that we saw. They sold a lot more, and the accounts receivable went up because of it. Inventories also went up. That's also consistent with the big increase in sales that we saw. If you're going to sell more, then the inventories have to go up as well. So these are total current assets. Current assets are the assets that can be turned into cash within 1 year. And so these two basically are cash. Accounts receivable, we certainly expect them to be collected within a year, hopefully within 30 days. And inventories we typically expect to turn over or sell well within the year. So these would be the current assets, the ones that we expect to be converted into cash within 1 year. Fixed assets are property, plant, and equipment. And sometimes that's how you will see it on the balance sheet, is instead of calling it fixed assets, it will say gross property, plant, and equipment. So the fixed assets are usually listed as gross fixed assets minus accumulated depreciation net fixed assets. So gross fixed assets is what were paid for the assets when they were purchased. So right here you see a huge increase in their fixed assets, almost a tripling of fixed assets. This is the depreciation that has accumulated to date, so it is the sum of all the depreciation expenses that have occurred, and we subtract that from the gross fixed assets to get the net fixed assets. So this is net of accumulated depreciation. So we can see, looking at this, that the total assets almost doubled, and that's due primarily to the increase in gross fixed assets, because cash and short-term investments actually went down, accounts receivable and inventory went up, and gross fixed assets went up a lot. So what we see on the balance sheet here is consistent with what we saw on the income statement, that the company is growing, and it's growing both in terms of assets and in terms of sales, not necessarily in terms of net income. So net fixed assets almost tripled in size, accounts receivable and inventory almost doubled, and cash and the short-term investments fell. Typically, these assets are on the left-hand side of a balance sheet, and then the liabilities would be on the right-hand side. So the assets are what you own, and the liabilities are how you paid for them. So just like on the asset side, we divide the liabilities into current liabilities and longer-term sources of financing. So again, just like current assets, current liabilities are expected to be turned into cash or paid within a year. So accounts payable is the flip side of accounts receivable. When we sell goods and we sell them on credit, that generates an accounts receivable. When we buy goods and we buy them on credit, that generates an accounts payable. So this means that we bought merchandise and that we have not paid for it yet. So we owe money to the vendors that we bought from. So you can see that accounts payable went up a lot, and again, that's consistent with the rise in sales that we saw. Notes payable are bank loans. So these are interest bearing, and notes payable are bank loans that are due within the year. Okay, so you can see that we had a big increase in notes payable here. So we're starting to see how that increase in assets that we saw on the balance sheet was financed. Partly, so the increase in inventory was partly financed by this increase in accounts payable, and then the bank loan is helping to pay for something. Accruals are money that we owe, and the two most important accruals that we see on financial statements are wages payable and taxes payable. So let's take the wages payable, for example. Every day that employees work, they are accruing money owed to them. And we don't pay people every day, and so each day that they work, they accrue a liability for money that the company owes to them. That's the accrued wages payable. Taxes are the same thing. Every day that we make money, we are accruing a tax liability. Typically, we pay our taxes quarterly, and so the money builds up as an accrued taxes payable over the course of the quarter. Then when we pay it off, we will reduce the cash account and we will reduce the accruals account, okay? So our total current liabilities went from $481,000 up to $1.328 million in this year. So we had a huge increase in current liabilities. So lots of short-term borrowing. The long-term debt also increased a lot. So long-term debt is borrowing that has a maturity of greater than a year. And so this company also took out a lot of long-term debt, and that was to finance this increase in assets that they had. They had a big increase in assets here. And so they are apparently financing it with long-term debt and some short-term debt. Now, on the liability side, or the right-hand side, we also show what are called the equity accounts. So if you think of this side of the balance sheet, it's liabilities and equity. These are the places that the company gets money to buy the assets that it has. And it can get the money either from borrowing, that's a liability, or equity, that's ownership. And so there's two basic ownership accounts that we see on the balance sheet. The first is the common stock account, and this shows how much money the company got by selling stock. So this was money raised from a stock issue. So you can see that nothing happened here between these 2 years, so they didn't pay for any of their asset purchases by selling stock. They paid for all of it by borrowing, both short-term and long-term, and using their accounts payable. Retained earnings is the money that has been retained in the business as opposed to paid out as dividends since the beginning of time. And we'll look at the calculation of this account in just a moment. But this is the accumulated net income less dividends that have been kept in the company since the beginning of time. Well, you remember that when we looked at the income statement, they had a loss of $95,000 in 2007. And so that is causing the retained earnings account to fall, because that negative net income or net loss is added in to last year's amount, and it caused the retained earnings to fall. So even though total liabilities and equity went up, just about doubled, that's all coming from an increase in debt. Their equity accounts actually went down, and so they end up with a higher proportion of debt at the end of this period. So what effect did the expansion have on liabilities and equity? As we saw, the current liabilities increased as creditors and suppliers financed part of the expansion. Also, the long-term debt increased a lot. The company didn't sell any stock, and retained earnings fell because they lost money in 2007. Now, this retained earnings account right here, there's a statement of retained earnings that explains that. And this is the link between the income statement and the balance sheet. When you create balance sheets in Excel, this retained earnings entry will be a formula. And it's going to be equal to last year's retained earnings plus net income from the income statement minus any dividends equals ending retained earnings. So retained earnings is the link between the income statement and the balance sheet. It's how income flows into the balance sheet. So it's a very important part of the financial statements. And so we can see here that not only did they lose $95,000, they also paid an $11,000 dividend. And so this is explaining now why their cash accounts went down. And so overall they had a $106,000 decrease in equity. Again, equity is ownership, and it comes from two places. You either sell stock or you make money and retain it. That's retentions or retained earnings. Okay, this particular year they didn't have any retentions, they had a net loss, and so their retained earnings account or their stockholders' equity account actually went down. Now, the final major financial statement is the statement of cash flows. And the statement of cash flows compares 2 years of income statement, well, 1 year of income statement and 2 years of balance sheets to tell you where the cash came from and where it went. Now, if we go back to the balance sheet for a moment and look at the assets. So what we're doing in the statement of cash flows is explaining the change in cash. So how we're going to do this is we're going to analyze, start with the income statement, and then we're going to analyze the change in these accounts between the 2 years. We do not include the cash account because that's what we're explaining, and we do not include retained earnings because we're going to include net income and dividends separately. Okay, so what we are going to explain in the statement of cash flow is this $1,728 decline in cash. Okay, so we already know what our answer has to be when we get done. It's the change in cash right here. So the statement of cash flow is divided into three parts: cash provided by operations, cash provided by investing, and cash from financing. Okay, so we'll go back and look at the cash from operations. Cash from operations starts with net income. So remember, we lost $95,000 in 2007, so we're doing the statement of cash flows for 2007. Okay, so again, this statement is explaining where did the cash come from and where did it go. The income statement it doesn't tell you anything about cash. So remember, a lot of these sales were on accounts receivable. So they made $5.8 million in sales, but if they didn't collect the accounts receivable, then they don't necessarily have any cash on hand at all. So this tells us how much money they made in an accrual accounting sense, but it doesn't tell us how much cash they had. Okay, so back to our statement of cash flows. So we start with net income, and then we make adjustments to net income to bring it to a cash basis. So the first thing that we do is add back the depreciation. And so if we go back and look at that income statement again, we had depreciation expense of $116,960 in this 2007. Okay, so we're starting with net income, and then we're adding back depreciation. We add back depreciation because depreciation is not a cash flow. It's an accounting entry. Remember, the cash was spent when we bought the asset, but we didn't record a cash expense when we bought the asset. We write the asset off slowly over time, and that's called depreciation. So it's an accounting adjustment as opposed to a cash flow. So we're going to add back the depreciation that was subtracted in that year to get our income statement to a cash basis. Then we look at the current assets and the current liabilities, and we analyze the change between 2 years. So if an accounts receivable went up, or if any current asset goes up, it means that we either spent money or did not collect money. So if accounts receivable goes up, it means you did not collect money. So that's like a use of funds. So if we look at our accounts receivable here, remember that it went up quite a lot, from 351 to 632. Okay, so 632 160 minus 351 200 is the number that we see in the statement of cash flows. So accounts receivable went up by $280,960, and so what that means is that we did not collect. It went into this accounts receivable. We did not collect cash, so that's a negative cash flow. Same thing with inventories. Our inventories went up by $572,000. This is the 2007 amount minus the 2006. So we spent money on inventories. So that's a negative cash flow. Now, if accounts payable went up, that means we borrowed, and accruals went up, we borrowed. So we helped pay for part of this by our accounts payable and accruals going up. So the same thing, an increase in accounts payable means we got trade credit or borrowed money from our creditors, so that's a source of cash. So an increase in accounts payable is a source of funds, and an increase in accruals is a source of funds because we deferred paying people. So we only are looking at the non-interest bearing current liabilities here, so we leave the notes payable out. So it's the operating current assets and the operating current liabilities. So we start with net income, add back depreciation, an increase in a current asset is a use of funds, an increase in a current liability is a source of funds. So we tied up money in accounts receivable, we tied up money in growing inventories, we helped to pay for that by trade credit, borrowing from our trade creditors, and by our accruals. So overall, the net cash provided by operations was a negative $503,936. So we had a big negative in the operating part of our statement. Investing activities, this is the cash used to acquire fixed assets. So this is the change in gross fixed assets. And so it's simply gross fixed assets in 2007 minus 2006. So they went up by $711,950, and change in short-term investments was $28,600. So if we go back and look at that, okay. So again, the current asset goes down, so that means that we sold marketable securities and that freed up cash for us. So there was a 28.6 reduction in short-term investments, and so that's a turning of that into cash, and so that's why it's a positive. Gross fixed assets went up, and so we had to buy the gross fixed assets, and so that is a negative. So our fixed assets increased, spent money, we changed our short-term investments into cash, got cash. So the net cash provided by investing is a negative $683,350. So far this company is quite in the hole. They've got a negative 503 from operations and a negative 683 from financing, and so the money's got to come from somewhere. So where did it come from? It came from financing. So here's where we look at the rest of the things that we've left out of the financial statement so far. So notes payable went up, that's a source of funds. Long-term debt went up, that's a source of funds. And then payment of cash dividends was not actually shown anywhere, so that was given, that had to have been given somewhere else. But they paid $11,000 in dividends. So the net cash provided by financing is $1.185 million. So then we put it all together, and we see that the cash provided by operations was negative $503,936. The cash to buy assets was negative $683. The cash provided by financing was $1.185 million. Add all that together, and you've got negative $1,718. So if you remember, the cash in 2006 was $9,000. We had a decrease in cash of $1,718, and so the cash ends up the year at $72.82. Okay, so again, to do the statement of cash flows, you just take the difference in between 2 years on the balance sheet. So you start with the income statement for a year, and then you compare that year's balance sheet to the prior year's balance sheet and calculate the change. So in general, if an asset goes up, that's a use of funds, and if a liability goes up, that's a source of funds. Now the exception to that rule was the short-term investments. If short-term investments, well, that went down actually, so that's not an exception to the rule. So the short-term investments went down, we liquidated them and got cash. But so when you do this, you calculate the change in cash, and that's your answer. So we looked at the 9,000 to the 72.82. So before we did anything, we knew that our answer had to be the difference, which is 17.18. So that's how you know if you did your statement of cash flows right. Okay. So again, the change in cash itself is not included in the statement of cash flows, but it is equal to the change in all the other assets and liabilities because a balance sheet must balance. Okay. Likewise, we did not analyze the change in retained earnings because retained earnings is made up of net income and dividends, and we treated those two individually in our statement of cash flows. So what can you conclude from the statement of cash flows? What we just said. Net cash flows from operations was negative $500,000. The firm spent $711,950 on fixed assets, and they financed all of this by borrowing, and they sold some short-term investments, but mainly they did it by borrowing, and even after borrowing, the cash account fell by $17.18. Okay, so those are the four major financial statements. The income statement tells us the results of operations, how much money we made in a given year. The balance sheet tells us the assets that we own, so the things that we own, assets that we own, and how they are paid for. That's the liabilities and equity. The statement of retained earnings explains the change in the retained earnings account between 2 years, and then the statement of cash flows tells us where the money went and where it came from. So we couldn't see this easily. You could see it, but not quite so easily when we looked at the other statements. So this tells us really nicely what happened to our money this year, where it came from and where it went. Now, the final thing that we want to talk about is stock price. So the equity that was sold is sold for a price, and then it trades in the market. So these are the stock prices at 2 points in time. So it was $8.50 in 2006, and it fell to $6 a share in 2007. There's 100,000 shares outstanding. Earnings per share is simply net income divided by the number of shares outstanding. And so remember, we had negative net income in 2007, so we have negative earnings per share. Dividends per share is the total amount of the dividend divided by the 100,000 shares. So they paid $11,000 in dividends, so that's a dividend per share of 11 cents. Now, a statistic that I wanted to show you is the market value added. Market value added tells you if wealth is being created by a company, if value is being created by a company. And we calculate it as the market value of the firm minus the book value. The market value, sometimes called the market cap, is equal to the number of shares times the stock price. Sometimes we add in the value of debt, sometimes we don't. You can see that the value of the debt typically is going to be the same here, and so it cancels out. So the total market value of the firm would be market value of the equity plus the value of the debt. Book value is the stockholders' equity or common equity account on the balance sheet plus the value of the debt. So if the market value of debt is close to the book value of debt, which it typically is, then we can just say market value of equity is stock price times shares minus book value of equity. So for this sample company, we had 100,000 shares at $6 a share, so the market value of the equity was $600,000. The book value of the equity, if we go back and look at the balance sheet, total equity was $557,632. Okay, so that's our sum of common stock and retained earnings. So market value 600,000 minus book value. What this 42,368 represents is wealth created. They lost money in 2007, and so their MVA, their market value added in 2007, was not as big as it was in 2006. We're going to, in the next presentation, look at Starbucks, and so you'll actually see a real company and the magnitude of wealth that companies is making. But basically, if you think of this as people contributed $557,630 to this company since the beginning of time, and they've turned that into a stock value worth $600,000. Okay, not very impressive. But for sure, we want this to be positive, and the bigger the market value added is, the better the company is doing, and the more wealth that they are creating. Okay, so that's a quick introduction to financial statements, and you might want to watch it again if you're not familiar with the financial statements. It complements the Understanding Corporate Annual Reports booklet that you have to go along with this. But I wanted to give you a different perspective to sort of explain what's in the book and to help you understand it better, I hope.